One of the most frequent questions that Peter has when he is mentoring people on using his methods is to answer questions about the MACD, how it works, what it is, what the darn thing means. And part of the reason for this is that it's not a simple indicator. There are actually several components to it that is a lot to look at, and people get confused. And the other thing is that there's an awful lot of stuff on the internet telling you to use the MACD in ways that don't really work very well for Forex. And people read these things and they get all excited and start using MACD in a different way and pay the price. So I thought that one of the contributions I could make to today's seminar would be to do a primer on the MACD. This may be far too low a level for some of you. If you've mastered the MACD and are totally comfortable with it, then you can take a little nap here. But for those of you who have been looking with crossed eyes at some of these charts and wondering where all this came from, this is for you. The MACD was developed by Gerald Appel, who was a stock trader. He must have been trading some pretty volatile stocks, and he wanted a way that would help indicate trends and momentum for this stock market, and do so to simplify the picture. And he didn't want to use ordinary moving averages. Ordinary moving averages are usually plotted right on the price data, and they don't really tell you very much. They smooth the lines. They are a following indicator. They're always behind the action. And he knew that there was more information in the bars, in the accumulation and the sequence of bars than that. He came up with a method of using exponential moving averages and plotting them as an oscillator. How many of you know what an oscillator is? Okay. An oscillator is an indicator that goes above and below a 0 point. Instead of being plotted on the price data, which of course is at whatever numbers the price has reached, the oscillator is going above 0 and below 0, and it's always returning to 0, even though price might be on a long-term trend climbing over days, months, years, but the oscillator will be keeping going back to 0 during that time. So it gives you an idea of the relative action compared to recent action for that underlying currency, and allows you to make short-term moves that are very well tuned. The two moving averages are made into an oscillator by a mathematical construct which I'm sure you're not interested in, but they behave very much like stochastics, which are moving averages that you might plot right on the price data. And you probably have all seen trading strategies for currencies that use two moving averages, a fast one, which means that it's based on just a few bars, and a long one, which means it's based on more bars, so it's smoother. And when these two cross, when the fast one crosses over or under the slow one, you're supposed to take a trade. Well, that might work for corn, or for something that is driven by fundamental processes, maybe it works for bonds, but the problem with currencies is currencies are too quick. If you wait for a lagging indicator like moving averages to cross over, you're never going to be in the trade soon enough, unless the trend lasts really a very long time. But you've seen in many of the charts that Peter's put up that the money is to be made when you catch a move fairly early, because it could all be over in an hour or two. So the moving averages serve to track the trend, and if you're ever in a situation where you're wondering what is the trend, you look on your hourly chart or your daily chart and you see, are the lines, the moving average lines of the MACD heading up or heading down? So a lot of the time MACD is not telling you anything you wouldn't know by looking at the price. It's following the price and it's showing you the trend, which is fine. And you can see here, even though MACD moving average lines cross over sooner than the standard sorts of moving average lines, it's still too late to catch the change here. If you wait until after those have crossed over and you got in here instead of there, you would miss half that move. The other thing that the MACD has is it has these little red lines here, and they are right sitting above or below the zero line. So if you look at the axis, the scale on the y-axis here, you can't on this particular printout read the numbers here. It doesn't matter. This is the zero line. The moving averages may go any distance above or below the zero line. Your charting platform will accommodate that. And in the meantime, this histogram is being drawn. And this histogram, each bar represents the distance between the fast-moving average and the slow-moving average. When the slow-moving average is above the fast-moving average, you're in a downtrend, and this histogram will be below the zero line. When you start moving up, when the price starts moving up here, even though the moving averages are still below the zero line, the histogram will start showing lines above the zero line because the fast-moving average has crossed above the slow-moving average. And this histogram is an excellent indicator of the momentum of the move. So you think of the moving averages as being your trend indicator, and the histogram is your momentum indicator. When a move starts, these little bars start off usually pretty small, and the faster they get big means the stronger the trend is, the stronger the move is. And when they cross over here, again, you see these formations like little rolling hills. If you see that the bars have peaked in their height and they're coming down, that means that the momentum has gone out of the move. And if you watch what corresponds up here to price, we got up to this pivot line, and now we're just kind of hugging this pivot line in here. And sure enough, the momentum from the move is fading away. Now, most oscillators will show divergence of the kind that Peter talks about. I want to backtrack for a sec. When we call the MACD or MACD, that name comes from MA for moving average. CD is for convergence, divergence. And that refers to the convergence and divergence of the moving average lines, which is what you're showing in the histogram. So one of the things that confuses people is the use of the word divergence in the name of the MACD compared to the use of the word divergence in the way that Peter is using it, where he is talking about a difference between price action and what the MACD is showing, either in its trend, in its moving average lines, or in its histogram. So if you look at this chart, I want you to get a pencil or pen out. You will see that it's the tendency of this indicator when price is flat. The indicator tends to all collapse around the zero line. And when price starts to move, the indicator will jump and pretty much do what price is doing usually. Then after that first move from when it's been flat, price will either continue in the same vein but with less energy, or it will go back the other way. And when it continues with less energy, that is a good sign that somebody, some market maker, some forces in the economic world are going to reverse what happened. The MACD shows you this by reverting to the zero line and then not responding as much as the price continues to creep up. And this is what gives you divergence. If you draw a line, and I want you to get a pencil out and do this, draw a line from the peak here, which corresponds to the high point of this loop of the MACD moving averages, and take it over to the next really notable price high. And if this vertical line is midnight in New York, what does this correspond to, this jump?
3 a.m. London.
You're picking up Europe?
Yeah, we're picking up Europe here. Europe got excited because it saw that, you know, the euro had been creeping up in afternoon action in North America and whatnot, and it jumped up. But then, and that was the dumb money, I think Peter would say, then other forces came to bear. And you could see that this was going to happen because if you draw another line from here over to the MACD's response to that little jump from London, you'll see that that line goes down from here to here, whereas from here to there, it went up. And then what happened? The price went down, and it went down pretty nicely. And that was a huge fall, because this was actually the high of the euro. This was the all-time high peak of the euro. And it fell.
Is this a daily chart?
This is a 15-minute chart. Okay. I just want to point out before going on to the next chart that on this charting platform, which is different than the one that Peter's been using, there's a little program where you can actually have it draw the pivot lines for you every day. The gold one is the central pivot, and then you have excuse me, that's not where the gold one is. I am not seeing this right. Turn it right side up.
Emily, can I ask you a question?
There is the central pivot. Yes?
Would you consider to draw a line from there to there versus there to there?
Mm-hmm.
Would you call it divergence?
It's not very good divergence because here you're kind of flat. I don't object to drawing a line between two price points that are the same and then looking to see if the MACD diverges from there. But if the two MACD points are the same, that's not as much of an indicator to me of anything. But you will notice that on any given chart, if you go about trying to connect all the lines you can possibly connect, you will see a lot of false signals in the MACD. The 15-minute MACD is generally more reliable than the hourly MACD, but I think the point is that you always want to be on the lookout for this, and if you are needing some suggestion of whether to pay attention to a bar pattern or anticipate how something will come out of a triangle and such, if the MACD is giving you a strong indication at the moment, then that's probably a very good signal. I would never trade with the MACD alone. It just would not be a good thing to do. So we have, in this chart, we can see a time when price was flat, MACD was flat. Then price moved, MACD followed the trend. Then MACD and price diverged. And then we had the follow-through there, where the price then followed the direction that the MACD had predicted. So to get the next slide, I pull the trigger, yes? When I do that, there we go. Okay, so turn your charts over. And actually this is an interesting example because here we have a double bottom, at least temporarily. And I want you to pick up a pen and start drawing MACD lines on this hourly chart and see how many of them, because this spans quite a few days here, more than a week. See how many of the indications on the hourly chart worked out or were good. Sometimes the MACD is making a perfectly good signal and then fundamental news or something intervenes.
Just going to put it in slide mode here.
Slide mode. Oh, thank you. So, there we go. So you all have this one where price has touched a double bottom, and what has the MACD done? Going up, okay? And we did temporarily, at least, go up. One of the frustrating things with MACD is that sometimes it gives a good signal, but it takes a while then for price to follow through. And if you're too quick to get into a trade just on the basis of MACD, you might be stopped out before you're proven right. I hate that, being dead right.
Out and right.
Pardon?
Out and right.
Out and right, yeah. Talking about it over breakfast instead of going on the way to the bank. So then we have MACD following price action, dropping. And here, this, I think Peter might consider this to be a shades of gray divergence. The MACD goes up a little bit here. Excuse me, the price goes up a little bit between these two bottoms.
But actually there's histogram divergence near the double, so
Near the,
closer to the double bottom. There's
yes,
histogram
that's
divergence.
right. That's right. That's showing. So here we have sort of a double bottom here in this narrow time frame. But look at what the histogram is doing. It's telling you that the downward action is really fading. And in fact, that's followed almost immediately by a nice move up. Then here we have a minor rise in these two bottoms, but we have a major rise in the MACD. It's come back 3/4 of the way from its lowest point, and that precedes a nice rise. So I want you to actually put your pen on this paper, because when you're trading, you have to at least have enough commitment to draw the line before you're going to follow an MACD signal. The faster moving average is always going to be sooner, and it's going, when you look back over charts, this is the frustrating thing. When you look back over charts, you will always see that the fast moving average pointed at the bottom or the top precisely. But try to trade it, because you can only tell that that was a bottom because of the action that came afterwards. And if you're trying to anticipate, for instance, this would have looked like a peak at the time and for quite a while. But looking back on it, it's just a little bump. And if you look at the slow moving average here, it's certainly not hesitating for that little bump. You know, so there's a tremendous amount of information in the MACD if you learn to read it. And you just study it on old charts, and you will see more and more how it helps you appreciate the amount of momentum in a move and the clarity of the trend.
So when you write your lines on the MACD, you use both lines. In other words, as you know, on the chart there, as it's going down, as a dark one's going down, like right there.
Okay.
Okay.
I would draw a line from the dark loops to the dark loops.
Okay, you would connect the dark loops.
But it doesn't really matter, you know, because you're looking over a time frame, you know, going back hours or days on the hourly chart, and the exact moment when that began and when the other loop made its turn that you're drawing the other end of the line to, that it isn't critical. Yeah.
So in that last example where price was going up a little
Mm-hmm.
and the MACD was going up a lot,
Right.
do I understand you to say that that's one example of a divergence where it wasn't they were in opposite directions, but the MACD was a much higher acceleration than the price? Do you
Right.
consider that divergence?
Well,
Because they didn't
they
exactly
were going in the
slope
same
different.
direction, but the MACD was going much more.
So the slope was greater, so
the
if
slo-
you've got a greater
yeah.
slope, that's a divergence?
It's a divergence in slope. Usually one is a positive slope and one is a negative slope, and that's easier to interpret. But sometimes you have, you know, as in this first example where the price is flat, no slope, and the MACD is showing a positive slope. And sometimes you have, you know, a small move here. This is a small positive slope, and the MACD is showing a really big positive slope. So it's just a good indication. I think I want to wrap this up by saying that all of the things that Peter is recommending to you work because they give you insight into the economic forces and the psychological forces that are actually driving price. When you see a bar chart pattern that indicates exhaustion, the reason we term that exhaustion is because the people trading have lost their enthusiasm for the trend that is getting exhausted. It's truly exhausted in almost human terms. And we can reduce this to a bar pattern, which we can recognize. That's why it works. It's not a magic thing. The bar pattern appears the way it does because of the human and market forces behind the price action in that bar. And the same thing applies really to pivot points. Pivot points appear to work like magic. Peter likes to say they're magic. I'm a statistician and a scientist, so I don't believe in magic. What I believe in is that traders believe in pivot points. They really do. And they will go along with the trend as long as it's in between pivot lines. But boy, when the price starts to approach a pivot line, traders will think twice, maybe back off, maybe hesitate. And that's why the pivot points are so potent. And that's why they will always work. So, any questions on this?
What do you draw the line below the prices and when up?
When I was first introduced to drawing divergence lines, I was told that you should draw the lines between the bottoms in an uptrend and between the tops in a downtrend. I don't think that's a necessary restriction anymore. Peter, do you? You don't follow that, do you? Seems to me I've seen you drawing lines between tops in an uptrend and between bottoms in a downtrend. Yeah. So it doesn't matter. What matters is that MACD is either tracking price or it's doing something different, and you just want to be able to find out when it's doing something different.
I'd like to ask you, even though there is a divergence from this point to this point and from this point to this point, even though it confirmed here, but if you look here, if you're in the trade here, there is a divergence between this line here and this line. There's a divergence. So you expect price to go up.
Well, what happened here is that we were in an area that I'm sure Peter would call a triangle, and so the MACD is not a stronger indicator than a triangle when that is setting up. What you have in a triangle is you have a lot of difference of opinion and no market certainty. And then the difference of opinion is dampening market action. So the bulls aren't winning and the bears aren't winning. This is a standoff, and you see lower and lower range bars. And this is an indication of a lack of certainty. And then even the way this came out of here, this was the end of the day in New York, goes into the evening. People still are not sure what's going on here. That's very flat. You can see this every day, by the way, that New York closes. Something happens in New York. It dithers about for a while. New York closes, and usually trading in the evening until midnight is pretty flat. And then things will start to happen again. Here, there was a lot of confusion. And I'm just wondering what day of the week that was. This was a Thursday. This was a Thursday. So then London opens, and things get going. And ultimately, the price did go up. But, coming out of a triangle like that, and then although this isn't a classic congestion phase, the price isn't going anywhere here. So this is the kind of wild chase that the euro can lead you on. If you had traded this, I don't have the pivot points on this, but I am sure that this was a tradable drop. And then you would see the hammer here, and you would see the spinning top, and you'd say, okay, time to circle the horses and go back the other way. I just clicked this thing by accident. And then you would be able to have traded that long. Although I still find it very hard to hang on when we get bars like this. But if you had gotten into the trade down here, you would watch that with a calm eye, I'm sure.
Many times I get people asking me, how can I customize MACD? Well, I don't recommend you do that because I don't know why you need to do that. You can use the standard default settings at any of the platforms that you're working on, and they work just fine. However, Joe DiNapoli has customized MACD, the settings for MACD. If you're using TradeStation, for example, or Supercharts, which I use both, I have both, you can actually customize your MACD settings by using these values here. And what it does is it gives you better entry points. It just fine-tunes, it gives you earlier signals on MACD. But for the purposes of this discussion, you don't need to remember this slide. It's not important. Just remember that you should use the default settings These are the settings I use. These are the default settings, and these are the ones you should use. Risk management is an important topic. Make sure you use your stops, and stops are very efficient in the Forex world. However, don't be fooled. They work 90% of the time. There are times when stops won't work. In a fast-moving market, they won't work. I mean, a market maker will fill you as best they can, but not necessarily where you want it to be filled. This slide is very busy, and you can read it when you get home, but let's just quickly go through it. Losses, keep them to 20 to 30 pips. We went over that this morning, and just to reiterate, to make sure that you put your stop at least 20 to 30 pips away from a pivot point or that event that caused you to go long or short. But where you see a wide-ranging bar like a hammer that's an obvious trade, then that kind of is an exception to that rule. Here's an interesting rule right here. Okay, we covered that. Trailing stops is something you can entertain. Does everybody know what a trailing stop is? Where you move your stop up as price progresses?
Can I ask a quick question, Peter?
Sure.
On your first point there, your first bullet point, keeping your losses should be 20 to 30 pips. If that's what your risk is, then what sort of price target should we be looking at?
That's a very good question. The question that was asked was risk-reward ratio. If we're prepared to risk 20 to 30 pips, what is the reward? And the answer to that is, it's a good question. The answer to that is the average trading range for the euros, 120 pips. I prefer to work with 76. The 76 has been sort of like the bellwether number. 120 is really what it is, but I find 76 works better for me. The risk is 20 to 30 pips. The reward is 76 pips. In other words, if you're trading the London session and you feel you've caught the trend, you're prepared to give up 20 pips for 76 pips. That's your risk-reward ratio. Does that answer the question? Oh, trailing stops. You can use trailing stops, but be careful with them. I don't know that I'm really enamored by them. And by trailing stops, I mean that once you enter a trade and you have your stop on, you can move your trailing stop up to protect your profits as price progresses. But sometimes price will snap back. Just as you move your stop, price knows you did it, and it'll snap back and take out. Price is smarter than you think it is. I like George Smith's idea of using limits and managing his trades, where he captures his trades at each pivot point. I kind of like that better than using trailing stops. I'm not saying don't use trailing stops. I mean, it's there. You can do anything. There are no ironclad rules in this business. Oh, I put this slide in here because there are some people who don't understand. There was one person I talked to who didn't understand that if you go long, you put the stop down here. And if you go the short, you put the stop up here. He had it the other way around. I don't know why he was confused, but I won't dwell on that because that's pretty obvious. Now, for the newbies in the audience, we're just going to explain some of the mechanics about how this works. And we're going to pick on the Swiss franc. Now, for those of you who understand all of this, you can turn your brain off for a minute. What this chart means is we're looking at a dealing window. It could be any dealing window amongst the market makers. And this is if you click on this button, you're going to sell. And if you click on this button, you're going to buy. Now, basically what this says is that $1 will buy 1.6824 Swiss francs. And using 100 to 1 leverage, what that means is that 1,000 US will buy $168,240, okay? Now, to explain how the pip spread works for you and against you, if you were to buy the Swiss franc by clicking here and then you went, oops, I made a mistake, and then you sold it immediately, you would have taken a loss because of the pip spread, okay? Do you see, does everybody understand that? So obviously when you buy and sell, you're buying because you assume the trend is going up, and you're selling because you're assuming the trend is going down. That's where the market maker makes his money, is in the spread. So you want to make sure you're on top of the market maker by trading the right way. As of December 1st, 2003, the NFA and CFTC declared that all futures commission merchants could only provide 1% accounts, which is 100 to 1 leverage from that date on. That's margin is 1%, which means that in a standard account, $1,000 would control $100,000. Now, not all brokers are equal. One of the brokers I represent, FX Solutions, have many accounts. When you open up an account with FX Solutions, and this is not a sales pitch, this is just information. They're not paying me to say this. One of the nice features about FX Solutions is you can open any type of account there, a standard account or a mini account, and they have different flavors of contract sizes. Okay? Now, what this means is that $100 controls $10,000 in a mini account. And if you decided to buy 10 lots in a mini account, you would need $1,000 to execute that trade. Now, FX Solutions will shut your positions down if you get down to 10% of margin. In other words, if you got down to $100 in your account, 1 penny below, they close out all your positions. It's just to protect you, okay? That's called a margin call. You can read this at your leisure, a little bit more detail. Hedging, we can skip this section. I'm going to click through the slides because we went through this morning. If it's not clear, you can read about it when you get home. There are different ways of hedging. We talked about hedging this morning where you go long or short and you click on the hedge button and you're hedged in the trade. Another way of hedging is if you're day trading but you want the luxury of knowing that you have something working over here in the background, what you can do is day trade, but also put a position trade on. Like if you believe the euro is going to really go up, why wouldn't you buy 1 to 10 lots of it and park it, and then do your day trading? That's another form of hedging, okay? FX Solutions is the only company I know that offers hedging, so it's a great selling feature.
So when you exit your hedging position, you'll get out of one side, is that correct?
Yeah, if you go long, if you're not sure what the news is going to be and you want to participate in the trade, you'd say go long and then hit the hedge button and then you're automatically live on both sides. You're long the euro and short the dollar.
Yeah.
And then when the trend reveals itself, you'd collapse the losing side. By collapse, I mean sell or buy, depending upon what the situation is, okay? Now, there are other ways of hedging, and you've got a handout. I think there's a handout in your folder. You can hedge with futures. Another form of hedge would be you could buy a stock. For example, one stock that I'm particularly high on is Novartis. It's a Swiss stock, Charles, Switzerland stock. And the reason I'm high on Novartis is because it's in Switzerland, and it's surrounded by the Eurozone. Switzerland did not participate in the euro. Okay, they're obviously with the Swiss franc. And at some point, in order to stimulate the economy, the ECB may have to lower rates to drive the economy up. And as the economy in the Eurozone improves, a company like Novartis they sell pharmaceuticals, and they're surrounded by the Eurozone. So this company would benefit from any improvement in the economy in the Eurozone. So that's another form of hedging. Okay? Now, you can hedge with futures for futures traders in the audience. The reason FX Solutions does not offer options is because they believe that hedging gives you the protection that you're looking for. In other words, when you trade options, you're basically trading the opposite position to a position you're already in, and hedging does that for you. Interesting point on FX Solutions, when you get back home, whether it's REFCO or wherever you're trading, not all market maker brokers segregate your accounts. In other words, when you're trading, your trade may very well be dumped in with everybody else's. At FX Solutions, your money is protected. At JP Morgan Chase, your account is traded separately. It's a big feature. No requotes up to $1 million, and you can trade 100 lots at a time if you want. I know a guy in South Africa who trades 55 lots at a time, and his average take is about 25 grand. The 4 major pairs we recommend are recommended because they represent the largest stable economies, represent low volatility, they're highly liquid, and they're popular. Does anybody know what cross rates are? Don't trade them. Most traders trade against the US dollar, cross rates don't. I don't know why you'd want, especially as a newbie, I don't know why you'd want to trade against something other than the US dollar. It doesn't make sense.
What is it?
Well, you would trade the euro against something other than the US dollar. That's called a cross rate. Average daily range. Does anybody not know what average daily range means? What this means is that in the case of the euro, it breathes 120 pips on average during a trading session from bottom to top or top to bottom. From bottom to top or top to bottom. It breathes. It has to put in an average of 120 pips over a year. One day it may be 40, one day it may be 60, one day it might be 140, but the average is 120. I prefer to work with a number of 76. That was the old bellwether number. 120 is the right number, but I work with 76. And the reason that's important is because let's suppose you're trading the London session and you figure out what the trend is. Let's suppose you're low in the session and you figure out that the trend is going up. You know that we have to put in at least 76 pips before the session is over. Okay? That's very important to know that. And the average daily range for the euro usually gets fulfilled during the London hours. Pip values. I assume everybody knows what a pip is. Like if the euro's at 2200, the rightmost digit, the 0, is a pip, or a point, or a tick. All three things mean the same thing. And the value of a pip can change from, in the case of the euro, it's $10.
Does these values differ from each market maker?
Sorry, no.
Standard?
Yeah, this is standard, $10. Now these change. The Japanese yen and the British pound change on a regular basis, but the Swiss franc and the euro don't. Pip spreads. FX Solutions offer 3 pips. Are you all trading with 3 pips? 4. At Refco it's 4. It's 3 at FX Solutions. I'm going to show you what very few people know. And this is so powerful every time I see it. My book, How to Trade Like a Pro in 1 Hour, was inspired by this. When I first saw this, I said, it can't be this easy. I couldn't believe it. I said, I have to tell people about it. And that's why I wrote the book. Basically why I wrote the book. Very few people know anything about this, so I'm going to show it to you. This is the website. If you go to that website there, it's a free site, okay? And it doesn't cost you anything, but the data is 1 month old, okay? If you want current data, the data I'm going to talk about is released by the CFTC every Tuesday. And if you want that data up to the current Tuesday, you can subscribe for it here for $4.95 a month. Did you get that? $4.95 a month. That's not a huge investment. That won't break your bank account. The money is well worthwhile. The guy that runs the site lives in Stratford, Ontario. We share links back and forth. As far as I'm concerned, it's the #1 site on the internet. Now, here we go. Are you ready for this?
Yep.
In 4 slides, it's 1, 2, 3, kaboom. And by the way, this part of the presentation is why most people think I'm a genius. By the time I'm done, you will all have swelled heads because you'll all be geniuses. When you go to this site, let's pick on the euro. And by the way, you can pick on any of the currencies because they're all here. But let's click on the euro and see what we see. Okay? When you click there, you come to this kind of screen and it gives you all these numbers. Now these numbers don't mean anything to me. I'm not a statistician and I can't figure them out. But Barry has figured them out for me. Then you go up here and you click on this button here and it gives you something that looks like this. Now I'm going to come back to the screen because I don't want to be here right now. If you click on that button, you come here. This is why I recommended on September 2nd of last year that people buy the euro. This screen that you're looking at right now. This is the same screen I looked at July 17th of 2000 that told me that the stock market was kaput. Now let's read this screen. If I can get this mouse to work. One of these days we're going to get a mouse that works. Right here what we're looking at is the CFTC, all the big dog traders have to report their futures positions. Now let's start all over again. There are no commitments to traders data for the Forex. It doesn't exist. But there is commitments of traders data for the futures world, which is a proxy for the Forex. In other words, if people believe that a currency is going to go up in the futures world, it's going to have a spillover effect into the Forex world. That's why this data is so important. We're looking at futures data here, but it applies, whatever happens to a futures contract is going to happen to the cash market. Okay? So right here we can see that the commercial traders were heavily short, and then they went heavily long up here. The euro, in the meantime, had gone down here, while the big dogs were going long. It was at this point that I told everybody to buy the euro. And it's not because I'm brainy or anything, it's just because the commercial traders were buying. And I'm going to show you a better interpretation of this in a minute. There we are at September 2nd of 2003, at which point the commercial traders had loaded the boat up on their futures positions on the euro. You didn't have to be a brain surgeon to realize it was a good buy. Anybody that took my advice in my newsletter made $8,000 during September per contract. Anybody that held on to their positions until February 19th of 2004 made something like $26,000 per contract, just by buying and holding and not trading. There we are right there. That's where I recommended a buy. As a matter of fact, I think George Soros and Warren Buffett bought at that point.
Would
Now,
they
here's
bought
wh-
on the futures
Sorry?
market? Would have they bought on the futures?
No, they were at the foreign exchange.
Yeah, on the FX?
Now here, let's look at this. Let's analyze this to death here. The big dogs were long in the futures world right here. That's why they're called big dogs. We're at 107.61, September 303. This was a buy and hold position trade. That run from there, September 3, all the way up to here, February 18th of 2004, up to 1.2929, resulted in a gain of 2,168 pips, or $21,680 per lot. I was wrong. I said 26,000, I think. If you'd bought 10 lots down here on September 3rd and held on, you would have made $216,800. Could you have handled that? You couldn't handle that? Murthy can't handle that. There it is. This is the chart that I saw staring me in the screen on September 2nd of 2003. When I saw that, I immediately got out my newsletter and I put in the recommendation. Here's how you read this chart. This is price action here. And this line here, which is not too readable, this orange line is the commercial traders. These two lines down here are a combination of the dumb money and the spec money. The blue and the green lines are the dumb money and the spec money. The dumb money never know where price is going, so we kind of discount them. But even the fund managers were short the euro at this point on September 2nd. I only pay attention to the big dogs, the commercial traders, because they're always right. They own 80% of the money in the market. Why would they be wrong? They're not paid to be wrong. Okay? Where you see this divergence, where the commercial traders are either at 100 on the long side or 0 on the short side, just mortgage your home, call up Brinks to the back door, and load the boat, and you'll make a ton of money. Now, the good news is I'm not just talking about the euro, because remember that slide where I clicked on the euro? You could have clicked on pork bellies, or you could have clicked on short. I still trade futures, and I use this data. What I do is once a week I go through Barry's site, and I look for this kind of divergence right here. And you know, in my newsletter, I always publish my picks, and people just rave about my picks because they're always right. But all I'm doing is I'm looking at Barry's site and telling you what I see. And so where I see this kind of divergence here, like this extreme divergence, I will buy Kansas wheat, or I will buy sugar, or I will buy whatever they're long on because they're always right.
You don't consider the one previous to that as an extreme divergence?
Here?
No, the one next previous.
Here?
Yeah.
No, it's not close enough to 0,
Oh,
and that's not close enough to 100.
okay.
Now, let's backtrack in time and let's see where we are today. We've been talking all day about whether we should be long the euro or not. I think some of us think we should be long the euro. Wouldn't you like to know what the big dogs are doing? Okay, let's go have a look. That's as of this week, end of week. You can see that the big dogs are not quite at 100, but I'd say they're pretty long. And the specs are pretty short. Now, who would you believe?
This is where we go down?
Sorry?
Is this where we go down?
Yeah, this is where you go down. Okay, come on, off your chairs. Let's go. Garth, let's get these guys falling off their chairs. Come on.
Amazing.
Everybody. You guys are incredible,
That's
really.
wake up call.
Thank you very much. I'm so proud of you people for doing that because it's, you know, thank you very much, Max. That's great. That's great. I hope we got that on film. Did we get that on film, Garth?
That was a good rehearsal. Can we do it again?
Yeah.
Give us 5 minutes, right?
Okay, there it is. This is, I wouldn't really react to this. It's not good enough divergence for me, but surely to goodness you can see that the commercial traders are longer than short on the euro, and that's pretty telling to me.
So
Okay.
is the blue line the,
Specs.
so they're
They're all time short. They think the sky's falling. They think the euro is going in the proverbial toilet. Would you believe them? Whenever I see a line like that where the dumb money, the blue line is the dumb money, whenever I see a line like that, I immediately become suspicious. These are the small specs who
Now you have a link on your site.
do this guy. Yeah, I really like this site. We're not brothers. We're not.
I didn't know what it meant, but.
Yeah, we're not brothers. I just happen to like his site.
Excuse me, Peter. So you don't want to take action on this unless you see it very, very near 100 and 0. Is that correct?
I really get more excited when it's up here at 100, but if I were trying to make up my mind on what to do with the euro right now, I'd be looking to go long. There's a bit of guessing in there because they haven't gone as far as but invariably what you'll see is they've come down a bit in their positions, but then they'll go back up again. But all I'm seeing is this is the dumb money here, just selling. They're all jumping off the cliff at the same time. And the commercial money is, the guys that own 80% of the market, they're on the other side of the trade. So they're saying the euro is more than likely going up.
And then the other side of the chart is just the opposite, right?
I'm sorry?
The far left side there. We've got just the opposite condition, right?
That's time passed.
Oh, you mean time passed?
Yeah.
They were short down here.
Yeah.
Yeah. They were short the euro right there. And the dumb money and the spec funds were long. So that was a good short trade. So you can see that the euro actually did dip there. So we've had look, 1, 2 good trades out of this. And I mean, if you buy and hold, the thing is, when you see this kind of divergence, the maximum divergence between 0 and 100, and you load up the boat and buy 10 lots and hang on for 3 months, you're making good money. That's a good way to hedge your intraday trades if you're experiencing difficulty with it. At least you know you got some money working for you.
What is the scale on the left? Is that 100% of those traders are long? I mean, what is that representing?
It represents the ratio of longs to shorts. In other words, what the CFTC does is they throw all these numbers into the pot. Barry takes the numbers and he plots them out. And let's just see if I can show you. Like they may be net short, but you can see they become less net short. And what it is it's just a way of ranking the difference between the longs and the shorts, how it works out. It's just
So
a
it's a
ranking.
percentage.
It's a percentage, yeah. So there we were, September 2nd right there. That's where we were, and as you know, the euro went up quite nicely, and then it formed a symmetrical triangle at the top here, which meant that price was going even further. Warren Buffett, as of the end of 2003, had $12 billion invested. Do you think he made money?
Nearly doubled that.
I kind of think so. For the first time in his career, because he's so down on the deficit situation in the States and he's so down on the US dollar, he's buying anything but the US dollar. He says that the dollar's got another 30% down to go. And as I said before, I use the same data to forecast the market peak. I picked the absolute peak of the market, July 17th, 2000, and it was based on this data. And a lot of my friends and relatives thought I was crazy. I mean, how can the market fall? It's been going up forever. Are you crazy? They're all wishing they'd listen to me.
What would you have clicked on here for the market? The Dow Jones or?
Okay, let's go back and look at that. That's a good question. On the screen here, see the S&P 500 down here? You would have clicked on that. I clicked on that line on July 17th of 2000, and I got the same charts. And the commercial traders were extremely short on the S&P 500, and I said, oh boy, this game's over. Now, if you were interested in trading gold, you can look here. I made an interesting call on gold not many months ago where I called a short on gold, and all the so-called smart experts in the paper were saying to buy it. The day after my newsletter went out, gold tumbled. Who could have guessed?
That's the trick they use all the time, though, isn't it? They get in position and then they tell everybody to buy it so they can get out.
That's right.
Or
That's
go
probably how it
opposite.
works. Yeah, that's probably how it works, yeah. But Barry has taken all of the major contracts. Like, I have to clarify, there's no difference between pork bellies and the euro. They're assets. They're tradable assets, okay? And all Barry has done is he's given you, and he assimilates the SCFTC data so you can read it in a proper format.
When is it updated?
Every Tuesday.
Every Tuesday?
I'm sorry, was there a question over here?
Yes, do you have to wait for the extreme divergence to make any sense of that, or?
Oh, there's no rules at all.
Or what would you, if you would have called it 2/3 up, when, let's say, the commercial traders were going, it was almost touching the price line, but not quite, you would still be right, or?
Are you talking about the slide I showed you before? Where the commercial traders were not really at 100?
Yes, yes.
Yeah. I would do a Joe DiNapoli. Joe DiNapoli says, when in doubt, use a little bit of this. Use a little bit of gut feel. My attitude is, on the previous chart where the commercial traders are not excessively long on the euro, I really believe that the euro is going to go up. So the fact that they're not really extremely long, I think I'd still buy. I mean, Buffett is. I mean, these guys, in another week or so, you may see that the commercial traders are at the 100 mark anyway. So, like Joe DiNapoli would say, well, buy it and see if you were right or wrong. Hopefully you were right.
So the end of the blue line means that the small index traders started going long again?
Well, it's a whipsaw effect. This is how the smart money, the big dog traders, make their money. They control 80% of the futures world. As soon as the dumb money comes to life and they realize that they're on the wrong side of the trade, they start buying, and guess who they buy from? The smart money, because they're selling to the dumb money.
Okay.
It's a slingshot. And they do like this. Now, I'm being a little bit facetious, but if it weren't for the commercial traders, you and I couldn't afford a box of Shreddies. Because the commercial traders are in the market. Commercial traders are buyers at Nabisco and Shreddies, and people, they're the big buyers. They have to know, they can't be wrong because they buy wheat in trainload, carload fulls. They can't be wrong, okay? And how they make money is they're always on the right side of the trade. They will buy, and then they'll sell, and then they'll buy, and then they'll sell. And they just, because they want an average price in the middle. So, to answer your question, when the question was related to what woke these guys up, as soon as they start buying, the commercial traders start selling. And you can see that all the way through here. See how they buy and sell and buy and sell? Okay, thank you. I really appreciate you falling off your chairs. That was incredible. Now, how to draw trend lines. I think Devi was interested in this one. I'm quoting Tom DeMark here. I'm a big fan of Tom DeMark and his book called New Science of Technical Analysis. I highly recommend you buy a copy. I don't get any benefit from saying that. As far as I'm concerned, I've been in this business a long time. I don't know anybody who knows more about trend lines than Tom. And what he says makes sense. So I'll tell you what I know about his trend line analysis. I think I'm going to skip over to this chart here.
What's the author's name?
Tom DeMark. Tom, D-E-M-A-R-K, capital M. His definition of trend line is this, and this may take a little bit of explaining. What you do is when you get a swing point like this, you connect that line to the nearest swing point previous that's down, and that's that point right there. Right there. You connect those two lines, and that's the uptrend. Now you can see by doing that, that's a good way of knowing that that's on the buy side. Okay? So that's the trend line right there. You draw that from that swing point to that swing point right there. There's nothing else, and it has to be down. It can't be sideways. It's got to be down. Okay? So that was the buy trend line. The sell trend line or the downtrend line was right here. Connecting that swing point, connecting this swing point here to that swing point there is the downtrend line. Okay, and as of this chart right here, that is the current trend line. This trend line becomes nullified by this one. So as far as this chart is concerned, the trend is down. And you can see that by knowing that, it gives you a good sell signal in here, because you know that you should be on the short side of that trade. Here it is in slow motion. This is how you connect your lines from swing point to swing point. And a swing point is where you have a low point surrounded by higher points. Okay? And where you have more points on each side of this swing point, it means it's a more important trend line. Where you see 4 lines on either side of the swing point, it's a magnitude 4 trend line. It's a very powerful trend line. Okay? Now, I had a gentleman ask me why he shouldn't be buying right here. I haven't shown you all the pivot points on here, but the reason this was not a good buy, obviously, was because we were at R1, which is a sell point, a resistance point. All of these indicators were pointing, the MACD was flat, and all of the other indicators were pointing down. And we had a down trend line in place right here. And we also had a topping out on price, but he wanted to go long. Well, there was nothing in there that suggested going long.
Peter, what did you mean by, you said magnitude 4 trend point, or?
Well, this is a magnitude 4 trend line right here.
What is that? What do you mean by that? Or what is that? The slope of it, or how many bars were lower than that on each side, or?
Let me draw it on the flip chart over here. That's a magnitude 1 trend line. That's a magnitude 4 trend line.
Thank you.
In other words, the more bars on either side of the swing point makes it a stronger trend line. This is a very strong trend line because you've got a lot of price action on either side of each pivot point. Here you've just got a little bit of price action on the other side. I would take this one over this one. Okay. Here we've got a whole bunch of trend lines. Let's analyze them as they unfolded. The first trend line on here is this one, where we connected this swing point right here to that swing point, and that was an uptrend. And you can see that it gave us, this buy signal in here. The second trend line is up here. I can't show you the whole trend line, but it connected from there way back up there. The third trend line was from this swing point back to this swing point here. And you can see that price, a nice buy area in here. The fourth trend point was from this swing point here down to here, giving you a sell indication. And then the fifth swing point was a very strong one. This is a magnitude 4 trend line. From this pivot point here, swing point, down to this swing point here. Okay, so you had 5 trend lines on there. And the fifth trend line supersedes the 4 before it. 4 supersedes 3, 3 supersedes 2, 2 supersedes 1. As each new trend line unfolds, the others are not trend lines. However, you can use the other trend lines for break and price action. In other words, where price breaks a previous trend line, either up or down, breaking support or resistance, or you can use that as a trading signal.
So after 5 fulfills, then you start drawing 1 again?
Well, no, you look for 6 now.
You look for 6, okay.
And we don't have, we actually do have a 6 right from that point, that swing point, up to this swing point here.
Right, that's what we have.
Okay. But I'd highly recommend you buy Tom's book and read the first chapter because it's really important information to know how to draw trend lines. Now, what would you have done here? Why? You've got an exhaustion bar here, and you've got a big, huge trend line down from there to there, if you drew it. And price action is below it. So if price action stays below this trend line, I'd be looking to sell. Okay? Here's an example of a trend line here that was broken on this triangle, and that was a good sell signal right there. And I showed you the results of that many slides ago, where price did break down for a couple days in here. So that was a good trade. Here's an example of how you can use trend lines to your advantage. This was the trend line here to the upside, joining that swing point to that swing point. And then it was superseded by this downtrend line here, connecting this swing point to that swing point. And 2 ways to trade this are, as soon as you see this downtrend line, you could go short. You could also go short when this support line is broken. In other words, this was an uptrend line, a buy trend line, a support trend line, but as soon as it's broken right here, right there, that's a good place to go short. TD diff, I like this indicator. This is Tom DeMark's TD diff indicator. The way it works is, this is actually a futures example, but I'm using this for illustration purposes. Tom says that where you have a situation like this, where you have, in an uptrend, where you have 3 bars down, where 3 closes are lower, like this close is lower than this one, and this one's lower than that one, where the difference between the low and the close on the last one is greater than the low and the close on the one before it, that means that price is going to go up. And you can see there are many examples on this slide. So just to repeat, where you see in an uptrend, for example, 3 bars going down, and the closes are successfully lower, and the difference between the low and the close on the 3rd bar is greater than the low and the close on the 2nd bar, that's a signal that price will go up. It works all the time.
How does that show on candles?
Sorry? Only with bars.
Okay.
Yeah, that's a good question. The question was how do you see this on candles, and it's designed for bar patterns. We've already talked about using this for buy and sell techniques. W.D. Gann, anybody heard of W.D. Gann? He suggests that if 2 consecutive bars make lower lows, a downswing will ensue, and if 2 consecutive bars make higher highs, an upswing will occur. Try it. It's very interesting. Simple technique. There are all kinds of candle patterns. I only work with 2. I work with spinning tops and hammers. I think that's enough. That doesn't mean to say you can't work with more. Let's have a look at them. This is a spinning top. This is what a spinning top looks like. This is what a hammer looks like. When you see price going down and you see an inverted hammer, it means price is going to go the other way. But I caution you that spinning tops and hammers only work well at the end of a run. In other words, if price has been going down and then you see an inverted hammer, it means price is going to go up. If price has been going up and you see a hammer the other way, price is going to go down.
How about in between?
Sorry?
How about in between when they're doing channels?
They don't work. Only at the end of a run. Okay? Here's how to read bars. Now this is for the stock world, but I just want to get a point across that if you don't know how to read bars, when you see a bar, this tick on the left is the open, this tick on the right is the close, the low is the lowest part of that bar, and the high is the highest part of that bar. Okay? In the Forex world, the close and the open are the same, as you know. Now here's an example of a spinning top, a hammer and a spinning top back to back. And see how we had a run up here, a hammer and a spinning top, and then price did exactly what you thought it was going to do. It went down. And it put in $700 per lot in 24 hours from that combination of hammer and spinning top all the way down to this triple bottom. Very powerful.
You typically use those only on the hour, or can you also use it on the 15?
Yeah, you can use it on all time frames. But it's really only effective at the end of a really nice long run. So if you see, sometimes you'll see a hammer spinning top railway tracks at the same time. Very powerful. Very powerful. Except at 8:30. Or 3, or 8, or 9:30. Now here's an interesting trade here. A position trade on the daily chart. We had a 1, 2, 3 bottom here. The 1, 2, 3 bottom was precipitated by railway tracks. The way you trade that is you buy when price goes above the number 2 point and then hold it until we got up to the double top. That was $13,000 per lot from spinning top to double top. From here to the double top was $13,000 in 2.5 months. Now, I said before that I only work with hammers and spinning tops. Now, I had a gentleman correct me, and he was absolutely correct. I called something a hammer, and he said, it's not a hammer, it's an XYZ. It's not called a hammer. I said, fine, you're right, but it's a shades of gray hammer to me. Like, I'd rather work with a hammer and call it a shades of gray hammer than to call it something else, the thing it's supposed to be called. So don't get hung up on all these fancy names for candles. It's not important. Keep it simple. If you want to know everything there is to know about candlesticks, you want to write this down. This is a good source of information on reading candlesticks. And if you want to learn about chart patterns, this is a good resource. I think I mentioned this before.
Peter,
Yes?
what would you say is the difference between trend lines and price? When you're using those two gauges, what's the biggest difference? If you say price and you say trend lines, to me trend lines is determining which way you think that price is going to go.
Yeah.
So what would be the difference between price and trend lines
Okay,
as far as a gauge?
Well, the question for the record is, what is the difference between trend lines and price as a determining indication?
Yeah.
Well, you're going to get some, like in this particular case here, we have a story, we have an uptrend, followed by a hammer and a spinning top. Okay? And then the trend line is broken. So the two things that have happened there is the candles really told us what the trend line told us. The trend line was broken, and the candles told us that the trend was over. So they complemented each other. So I don't know, like candles participate in trend lines. So you're going to see on a trend line candles and hammers really participating in telling the same story. So I think, if you want my honest opinion, Jeff, I think one of the most important things to use in trading is trend lines. I would say if I had to rank them, I would say trend lines and MACD divergence are probably the two most important things. Would you agree with me, Debbie?
110% or 1,000% I agree with that. 1,000%.
Where you see a trend line broken, it's broken. I'm glad you agree with me, because that's kind of the way I feel.
The power of those two is very strong.
Yeah, if you just pay attention to, I think that answers your question, Jeff. If
Yeah,
you,
so basically what you're saying is the trend line and the other indicators, the price is just what happens to it from those other indicators is what you would determine as price on that gauge.
yeah.
Okay.
Yeah, with the difference between using, say, trend lines as your only indicator is like Debbie said. If I see trend line broken, to me that's gospel. It means price is changing direction. With candles, if I only see a hammer without a spinning top, I like with bar and candle formations, I like to see a couple together, like a candle and a railway track or a hammer and a railway track, as double insurance. But where I see a break in trend line, boy, you can't ignore it.
Break means the candlestick should form completely, right?
Sorry?
That candlestick should have formed, the new candlestick should have come in later on. Say you see a candlestick there, the long red one, it broke the trend line.
Yeah, right
so
here.
It closed below. So
As soon as it breaks the trend line, the trend line is broken.
even though it's still forming.
Well, you would see that on the this is a 1 hour chart. You would see the trend line broken on the 15-minute chart or the 5-minute chart. And that's where, when you see long bars like this, you're going to see what's underneath it at the 15-minute level or the 5-minute level. That's why you should have all these things on your screen. Because if you're only using the 1 hour chart, all you see is a big candle. Well, excuse me. But if you have the 15-minute chart and the 5-minute chart, you can see what's happening underneath. I'm going to whip through. We've done that one before. And here we're talking about candles. Here we have railway tracks, which sent price in another direction. Here we have a hammer. Now, does anybody not know what railway tracks are based on what I've said so far? They're very powerful, especially when you display them as bar patterns. What it means is it's a form of exhaustion where traders were going south and then all of a sudden they said, oops, I'm going the wrong way. And then they start heading north. That's called railway tracks. Very powerful. Whenever you see railway tracks, it's not a sure thing, but it's very powerful. You can see it's powerful. I'm showing it to you.
Question, would a broken trend line supersede a pivot point? Like, would you pay more attention to a broken trend line as opposed to the position of a pivot?
If I saw a broken trend line in between two pivot points, I'd react to it. Trend line is very powerful. I mean, the trend line may have been broken in between two pivot points for a very valid reason. There are exceptions to the rule of trading at pivot points, but I would say they relate to, as I said this morning, if I see a trend line break in between two pivot points, or if I see a hammer, spinning top, and railway tracks in between two pivot points, it's meaningful information. But generally, you don't see it that often in between pivot points. Here's railway tracks, very obvious. Here we have an outside bar. An outside bar. For those of you who don't have my report on how to read bars, let me know and I'll send it to you. It'll explain all of this to you. An outside bar is a bar like this one here, where it encompasses the full range of many bars before it. You see where we had an uptrend? And then we have an outside bar here, which encompasses the price action up to that point. It means the price is going to go the other way. There's another outside bar right there. This is what I call a swing point or a price rejection bar. Railway tracks up here. Price rejection. Here's an example of, I've talked about retracement before. Here we had a run up to the top and then a 50% retracement down to this level. The example I gave you before was an example of a 2/3 retracement backup. I think I showed that to you earlier. Here's an example. We're in that segment in the presentation where I'm showing you bar patterns and chart patterns. This is an example of a symmetrical triangle on the 15-minute bar. Now, when this is in a downtrend, going into a symmetrical triangle, what do you think price is going to do? There it is on the 1-hour chart. And you're right, price went down. So that's good, you've got that. Here's an example of a head and shoulders pattern. Remember I said that you don't have to wait for the new session to unfold before you start trading. Here's an example of the new session started here at midnight, but in the late night trading over here, we had a head and shoulders pattern. There's the head, there's the left shoulder, there's the right shoulder, and that means that price is going to go down. Okay, as it did all the way through the following session. So you could have initiated your trade over here before the new session started. Here's an example of a channel. Coming into this session here, we had a channel. And of course, it broke down through the bottom part of the channel and then punched through this pivot point, which is a good short situation. Here's an example of an inside bar right here. An inside bar is, remember how I explained to you that an outside bar at the end of a run encompasses prior price action and it's a signal that price is going to go in the other direction? This is an example of an inside bar where it's the exact opposite, where you have a narrow bar in between a big bar before it, and it tells the same story, that price is going to go in the other direction. We had price coming down, we had an inside bar, and then price went up. So outside bars, inside bars, railway tracks, they all tell a very powerful story. Add that to the mix of trendline analysis and MACD divergence and so on, and you guys can make a lot of money. Do you believe that?
Yeah, sure.
Oh, that's good. I'm glad you said that. That was the right answer. To reinforce hammers and spinning tops and such like are only really meaningful at the end of a strong run. Watch out for 3 a.m. ET, 8 a.m. ET, 8:30 a.m. ET, and 9:30 a.m. ET. Okay. As you know, price will meander all over the place and form different shapes and sizes and patterns, and it's a question of how do you get your mind around where price is going. When you're looking at a chart like this, what do you see? Not a lot, do you? Pretty hard to trade that chart, isn't it? There's nothing to look at except price action. By superimposing my pivot points on this screen, and I'll show you how to do that in a minute. It's like a radar screen on a plane. You have something to look at price in relation to. Okay? as Emily alluded to earlier, most other systems out there, other than mine, are based on moving average crossovers that don't work in the Forex world, okay? Because they trigger too late, and they always leave you in the middle of nowhere. So you have to look at price through a filter. There are other approaches to trading the market, and somebody asked me at break time about Fibonacci. I'm not a big Fibonacci fan, especially in the Forex world, because I don't believe that Fibonacci, Gann concepts, and moving averages work in the Forex world, because the Forex world is a very iterative, dynamic market, and these applications are linear in nature, and I just don't think they work. I mean, I'm sure there are people who would disagree with me. So I respectfully submit that the best way to trade the Forex is a combination of pivot points and a few other indicators that we're going to talk about this afternoon. Most professional traders at banks and financial institutions use pivot points because pivot points originated in the pits in Chicago. When floor traders jump into the pit to trade, they don't do it blindly. They've done their homework the night before. And what they do is they write pivot points on the back of their trading cards, and they're constantly flipping them over and looking at price action in relation to pivot points. This is not a new concept. All I've done is I've made on-floor pivot points available to off-floor traders. Pivot points are understood by anybody who really knows how to trade. So here we go. I have added 4 pivot points to the standard pivot point set is 5. I've added 4 of my own to make the final complement 9. And these are the 4 most important pivot points you're going to work with: M1, M2, M3, and M4. Here's the full range. When you're using my system, you're going to calculate pivot points from S1 to R2. It's very important we spend a little bit of time on this. Well, the way it works is when price action is below the pivot point, you should think buying. When price action is above the pivot point, you should think selling. However, you have to think a little bit like a fighter pilot. A fighter pilot, when he's reading his indicators and he's flying straight like this, sees one thing. But then when he flips over upside down, he interprets information a little bit differently. The same thing here can apply. And the point I want to make here is if, for example, the night before, we saw a head and shoulders pattern up here the night before our current trading session that would lead us to believe that price is going to go down, then price starts coming down into this area below the pivot point. This is no longer a buy area, it's a sell area. So all I'm saying is that support levels can become resistance levels, and resistance levels can become buy levels. It depends on the trend, it depends on where price is going, okay? But normally the bias is buy here, sell there. It's just a guide, okay? My system works based on taking the open, high, low, close for the previous trading session, and I'm going to show you how to do that in a minute. I use a variation of, there are 3 different approaches to pivot points. I use the traditional method. I use the standard 5 set, and I've added 4 of my own to calculate not just 5 support and resistance levels, but 9, okay? And the most important ones are M1, M2, M3, and M4. Here's an example of a particular day, June the 13th, 2003, where I keyed in the open, high, low, close for the previous session, and my program calculated these pivot points for the next session. Now, just a point of explanation here. This question sometimes comes up. Based on my calculations, if, looking at the last 24-hour session, if it closed low in relation to the open for that 24-hour session, you use M1, M3 as the estimated low and high for the next session. If the close for the last session was above the open for the last 24 hours, you use M2, M4 as the projected low and high for the next trading session. That's all that slide says. So the steps I use for my own situation is I determine the open, high, low, close and the range for the currency. I calculate the pivot points based on the 1-hour chart, and I'm going to show you how to do that in a minute. I open the charts that I want and plot them on the screen. I plot the pivot points and the indicators I want to use, MACD in most cases. I look at price action in relation to the M1, M3, M2, M4, and the pivot points and the range for that currency. And then you just trade support and resistance, remembering that support can be resistance, resistance can be support, and the other way around. Just think like a fighter pilot. One day it's one way or the other. But it's determined by price action coming into the session, whether price is trending down or price is trending up.
Session by meaning 12 midnight?
12 to 12. Yeah, I'm going to go over that in a minute. So here they are again, the 9 pivot points. So what are we looking for? We're looking for the bias going into the session. We're looking for any news that may be germane to the session. We're looking for the low and high, M1, M3, M2, M4. We're looking at the pivot points and the range. We're looking for breaks and bounces and retracements in relation to the pivot points and trading support and resistance. So as I said before, buy below the pivot point, sell above the pivot point. Don't sell below the pivot point. Don't buy above the pivot point. But sell when support is breached and buy when resistance is breached. That's it in a nutshell right there. If you remember this slide, if you understand this slide and remember it and apply it, that's all you have to know. The central pivot point is kind of neutral. It's almost like the neutral zero line on MACD. It's fair game for support or resistance depending upon price action. So your trading toolbox should include anything to do with news. You should be using MACD. You should know how to read trend lines. You should know how to use my pivot points. And you should know how to instantaneously read bar and chart patterns or even candle patterns. Okay, you really have to become familiar with these patterns. And you have to know how to work the multiple time frames. So to summarize, what you want to do is study the trend before the new session, calculate and plot your pivot points, check where price action is, look for clues like reading bars, assess the news and macro indicators, specialize in one currency, the euro, as an example, and press enter only when you see something to do. I had a discussion with somebody at lunchtime. I think it was Peter. Yeah, we were talking about not rushing trades. My attitude is I want crystal clear trades. I'm not really interested in things that kind of look like they're a good trade, but they're not a good trade. Like where you see MACD divergence, but it's kind of wishy-washy. Maybe it's not really MACD divergence that you want to react to. Okay, now we're going to talk about my system. And I've used the airplane analogy mainly because I had to come up with a way of explaining how to fly with my system, pardon the expression. If you were to jump into a plane, what I've done is I've superimposed a chart. Pretend that this is your windshield on your plane. and that these are your dials. Well, you're not going to fly a plane without indicators, okay? And you're not going to trade a chart without something to look at on the chart. So there are similarities between trading and flying. So what we need is we need a plane that looks a little bit more like this, where our dashboard, what you need to do when you're trading is you need to pretend you're flying a plane, and you must trust your indicators, because pilots trust their indicators. Unfortunately, John Kennedy Jr. didn't, and he crashed and died. But if you're going to trade, you must believe what your indicators are telling you. Otherwise, don't look at them. It's just like flying a plane. If your visibility tells you the plane is going one way, but your indicators are telling you you're going another way, believe your indicators, okay? So that's why I've used this analogy. So when you're flying your plane, you want to have news, you want to be looking at bar patterns, chart patterns, you want to be working with MACD. Your pivot points are sort of like the radar screen in the middle of your dashboard. Price action is important, and trend lines are important. So as you're trading, you should be thinking of these 5 things at all times, because they're going to paint a picture for you. Now we're getting into pivot points. This guy here, Anthony Scott, I've gone back to the pivot points breakout system after trying something else, and it is only getting better this time. Why are pivot points important?
It's a filter.
The traders believe.
Because everybody believes it.
Good answers. You guys have been paying attention. That's great. Here's another part of the answer. Support. Let's talk about support and resistance. Pivot points are really support and resistance. Below the central pivot point is support. Above the central pivot point is resistance. Support really means that at certain points in time previously, buyers were attuned to buying at a certain price. You don't care what the reason was. A lot of buyers were buying at a certain price. It meant something to them. Therefore, it became a pivot point or a support point or a buy point that's meaningful going into the future. It meant that over here, it meant something to these traders. Now into my new session, I look back and I say, well, gee, they thought that was a buy back there. It's meaningful. Resistance means that in past history, sellers thought that this price was a place to sell. And going into the new section, I look back and I say, oh boy, they were selling back there. That's an important point. They're psychological levels. They're not pieces of wood. They're psychological levels that mean something to all professional traders. And I've had people say, oh boy, price punched through a pivot point, and it really took off. There's follow through because most professional traders understand pivot points. And there are automated trading systems out there that kick in when price goes through a pivot point. That's why you get follow through, and that reinforces the idea that they're very important. Calculating pivot points, how do you do that? Here's how you do that. I want you to think about a number of things on the screen. I want you to work with the 1-hour chart. Some market maker brokers cut off at 5 o'clock and some cut off at different times. I don't care when anybody cuts off. It means nothing to me. And I don't want you to, for example, one of the things I don't like about FX Solutions, sorry Tom, is that I believe, I stand to be corrected on this, but if you go to the daily chart at FX Solutions and click on the rightmost bar on the daily chart, they'll give you the open, high, low, close for the next 24 hours, or for the last 24 hours, but it's not 12 to 12, it's up to 5. So to make a long story short, what I recommend you do, regardless of what platform you're trading on, be it REFCO or FX Solutions or whatever, go to the daily chart. And what we're going to now do is we're going to get the open, high, low, close for the last 24 hours. And let's just beat this horse to death here. We are, let's pretend, let's stay away from Monday. Let's pretend that we are now at Tuesday, next Tuesday. And we're wanting to trade the Tuesday session. Okay? So what we want to do is we need to get information from the previous 24 hours for Monday, from Sunday midnight to Monday midnight. We need the open, high, low, close, so we can calculate the pivot points so we can trade on Tuesday. Are you with me so far?
Yeah.
Okay. That's where we're at in the scheme of things. How do we get the open, high, low, close? I'm going to explain that to you now. What I want you to do, regardless of what platform you're on, I picked FX Solutions here. I want you to go to the 1 hour chart, and this is the 1 hour chart for the euro for this particular day. And what you do is, this is not very scientific. What you do is you eyeball it. Okay? Here's the open at 12 a.m. on this particular day. Here's the high for this particular day. Here's the low for this particular day. Here's the close for this particular day. Okay? Now, there's the open. That's at midnight. That's the highest high just by eyeballing it. There's nothing higher over here. Do you see anything higher? Okay, that's the highest high for this 24-hour session right in here. Right in there. That's the highest high, that's the lowest low, that's the close, and that's the open. Do you see that? You with me? Okay. And you know that by just, you move your cursor over. You move your cursor over to that bar and you touch the bar and it shows you open, high, low, close. In this particular case, I want the open. So I take the open number and I put it into my spreadsheet at forexmentor.com. When I move my cursor here, I get the high and I take that and I put it in here on the forexmentor.com spreadsheet. Then I get the low over here by clicking on this line with my cursor. I get the low and I put that in here on this spreadsheet at forexmentor.com. No decimals, by the way. I get the close here on this bar and I put it over here in this part of the Forex Mentor spreadsheet. Okay? And the way you put it in here is you just click on the space, enter the number, then 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 click on open space, and it'll calculate all of these pivot points for you here. Because whether you're in Hawaii or Timbuktu, you're trading based on New York time.
Right, but the charts that I'm pulling up, won't they be at the time that I have my computer set to?
If I'm using FX Solutions, even though I'm on, or if I'm using Commerce Bank, and even though I'm in Victoria, it shows me Eastern time. Okay, on the chart?
Yeah.
And the reason I picked 12 to 12 is because I want to calculate my pivot points in advance of the London session at 3 a.m. Because that gives me 3 hours for these pivot points to mature. See, now, I'm going to also explain to you very shortly that you can recalculate the pivot points at other points in the day. You can recalculate the pivot points at 7 o'clock in the morning after the London session. Or you can recalculate the pivot points at 1 in the afternoon after the New York session. Okay, because what that does is after the London session, you can recalculate the pivot points based on that action. And then at 1 o'clock in the afternoon, you can calculate the pivot points based on the New York action and get a closer reading. If you want to, you don't have to.
And do full 24 hours as well?
Yeah, if you do it at 7 a.m., it's 7 a.m. to 7 a.m. If it's 1 p.m., it's 1 p.m. to 1 p.m., 24 hours. But do it off the 1 o'clock chart.